very much. And this is my much preferred method of speaking, which is to get other people to do all the talking. So our panel here is called How to Make Blended Finance Work, essentially. And I would like to reframe it a little bit as how to get it to work for the large ticket parties in the equation. What you have in front of you are some very large scale institutions operating in the way that we need to operate in order to move the right amounts of capital forward. So let me kick off by just asking each of you, and I'll start with Paul and work my way toward Audra, to describe very briefly your institution. Are you an investor? Are you, a multilateral development? What are you? And in what way do you tend to use blended finance?
Thank you, Joan. Thank you for the invitation to be here today. It's a real pleasure. So BlackRock is a fiduciary asset manager. We manage around $9 trillion in assets on behalf of our clients. And our purpose is to help more and more people experience financial well-being. So in the context of blended finance, what this means is giving our clients and their end beneficiaries, ordinary savers, retirees, access to investment opportunities, for example, in developing markets, in climate and other areas, and to connect the need to build climate-friendly infrastructure in emerging markets, and the opportunity that that creates with the supply of capital seeking returns. And in order to do that effectively, we have looked to blended finance structures to make that work.
Hi, and thank you for having me. My name is Omar Farouk. I'm from Bank of America. At Bank of America, sustainability is part of our core strategy. It's part of how we do business. We have two North Stars that guide us. It's a net zero commitment for 2050 and 1.5 trillion of deployment and mobilization of capital by 2030. What that means is we work with our clients to help them transition to net zero, to help solve their problems, and we work with investors to source opportunities where they can make investments for that net zero pledge as well. I'm responsible for our sustainable asset finance business. That includes a lot of renewable energy, a lot of what folks have talked about, really at the asset level and taking it from idea to execution.
Thank you very much, John. And I'm Cruzcaya Sierra Escalante. I represent IFC. We are part of the World Bank Group, and we are the only DFI focused exclusively on the private sector. How we have used blended finance? We have been using blended finance for about 20 years. It started in the climate space, so very much aligned with the strategic priorities. In 2017, we moved to use blended finance to increase our investment in the lowest income countries and fragile contexts, so climate, low income, investments, gender, and more recently, to support fragility and food security.
Hello. Hi, my name is Hiromichi. I'm a UN Special Envoy on innovative finance and sustainable investment, but many of you still regard me as the former investment chief of Japanese pension fund, GPIF. I have been promoting ESG and sustainability to change the financial and the capital market and ecosystem, and then now I'm no longer, feel humble to be called as the expert in blended finance, but I've been trying to cheerlead all these panelists as a UN Special Envoy, but I can talk about my involvement in some innovative finance scheme working with the ADB and some other sovereigns. Thank you.
Morning, everybody. It's a pleasure to be here. My name is Audra Loh. I'm CEO of Clifford Capital. And how do we use blended financing? I think Clifford Capital in itself is a model of blended financing. We are a specialized structured finance, project finance lender that is established with support from the Singapore government, and we are combining effectively debt that is supported by the Ministry of Finance in Singapore with equity from the private sector to do our work, which is to help Singapore companies grow in overseas markets. And a large part of what we do is in the infrastructure sector where we provide project financing. In terms of the modality in which we use blended financing most commonly, I would have to say it is in the use of political risk covers, most commonly with our MDB partners. And we do that when we finance greenfield projects in emerging markets, particularly in frontier markets, where we as a commercial lender also do find it quite difficult to manage risks such as political risk. So that's, yeah, that's how we use blended financing. Thank you.
Thank you. And last but not least, Fabio, who's with us virtually, probably at a horrible time of night, if I'm guessing correctly. So over to you, Fabio.
Yes, it's about 6:20 here in Italy. So thank you, first of all, for inviting me. I think climate has become an increasingly important topic at the fund. We cover climate from climate policy, including carbon policies, to green investment, to I work in the monetary and capital markets, so we focus more on the financial side of this. So whether this is the regulatory aspect related to climate, whether this is financial stability issues, so in the financial sector assessment programs that we do for systemic countries, monetary policy, as well as the sustainable finance side of it, which is what I'm responsible for. I think the point is like we know that 2/3 of greenhouse gas emission now come from emerging markets. We know that with COVID, debt levels are very high, external financing costs are tightening. So private finance need to play a crucial role, and we need to scale this up very quickly. And so when we think about climate finance, we think of this together with policy, as well as what we call the climate information architecture, so data, standards, and taxonomies. But it is an important, crucial role, part of the package in terms of climate work.
Thank you. And it may be a surprise to some to see the IMF in this conversation, but hold that thought because they are very much in this conversation, and we'll come back to Fabio in just a few moments. I'm going to start with the two commercial institutions on the far end of the row here and ask Omer and then Paul. But Omer first, whose money does BOA work with? What kinds of risks and returns do they need? And given those boundaries, what blended finance tools are useful? Because we're talking about blended finance in countries that don't have a lot of track records. They don't generally have a long deal track record as a country, and there's not a lot of information, therefore, for commercial investors. So,
yeah, let me
go ahead.
Let me first start with pools of capital. So we're a large global bank, and we have access to capital through investors, through corporates, and also then our own balance sheet. Our own balance sheet is, regulated bank. We have very specific criteria on risk tolerance there. But then we do a number of transactions, and a lot of our mobilization is structuring transactions that are then placed with investors. When we think about transactions for our own balance sheet, we are a institutional investor. We are a for-profit enterprise. So we are looking at risk and return, and we're looking at it, I would say, two ways, right? This is, I think, an important question. Are we the best holder of this risk, right? And sometimes we are. And in that case, you'll find us to be fairly constructive, and sometimes we are not. And that's very important because the best holder of the risk will be the best pricer of that risk. So there's some things we know, some things we don't know. And we're very clear and honest about that. I think blended finance, if we think about it in the context of structured finance transaction, the tools are not new. I mean, we have allocated risk between parties as far as 20 years ago. In certain transactions, a party is better at the rate risk or the currency risk, and somebody is better at the credit risk. So we know that technologies, I think that concept is frankly in all of our transactions. Where MDBs come in and where blended finance becomes critical is that we, if I look at an emerging market, we may know solar or wind, the technologies really well. We may actually have, hundreds of megawatts of gigawatts of that exposure, where we are tracking data on a regular basis, but we don't know currency controls. We don't know the stability of the policy. We may not know the off-takers and what their financial structures are. So I think it's taking the risks that we know and pricing those right, and working with MDBs to understand those risks. And I think it's very critical that the private sector is involved and is not just placing the paper, because what we find is when we're in a market and we see the asset perform and the cash flows flow through the system, there's a learning curve there. And the more the private market sees that asset perform and see repayment of lending or equity returns, the more capital it'll crowd in.
So basically, structured finance, old technology, blending just allows a new party to take some of those risks off the table that otherwise you're not the appropriate party to take. And okay, so got it. And over to Paul. sort of a similar question. You're obviously a return-seeking, market-principled sort of investor as well. But we've seen you do blended finance, most notably the transaction that was up on McKinsey's slide earlier, the BlackRock Climate Finance Partnership, which drew hundreds of millions of dollars of capital. Maybe we can ask you about how that one came to be, what the blending mechanics were, and why did it turn out to be exciting for institutional investors? It wasn't just risk mitigation, right? It was also about scale. So walk us a little bit through that specific transaction so people get a sense of the sorts of things that institutional investors can actually do.
Sure. So, we've talked about the fact that there's a need to scale up investment in clean energy dramatically in emerging markets if the world is to stay on track to the climate goals that have been set. Probably a tenfold increase is needed. So we talk a lot about and talk about the problems and the challenges. So we really wanted to focus on the solution side and to roll up our sleeves and see what we could do in a way that offered, our investors access to investment opportunities that they were interested in and how to solve that equation. And the answer was blended finance. So we set up something called the Climate Finance Partnership, which was done with 3 development finance institutions, France's AFD, Germany's KfW, and Japan's JBIC, and 3 foundations, philanthropic foundations, that created the catalytic layer that enabled us to raise capital from institutional investors. And that catalytic to non-catalytic was done at a fixed ratio of 1 to 4. With a focus on renewable energy and other climate infrastructure in emerging markets, Asia, Latin America, Africa. And so that's what we set out to do. It took a while, I would say, to structure that vehicle in a way that made sense, right, to all the parties. But interestingly, especially the catalytic part, and this maybe we'll get into a little bit later, is kind of part of the dilemma of what it takes to help private and public capital work together at scale. But once we had done it, right, once we had figured out the catalytic piece, what we were able to do is take this out to institutional investors and offer a very simple value proposition, which was, we can give you exposure to emerging markets, clean energy, at OECD levels of risk. And there was huge interest in it, including from investors who hadn't necessarily invested a lot in emerging markets before. So the lesson was, it works, but there were also some lessons learned about the amount of time it took to structure the catalytic piece in a way that would then appeal to institutional investors.
So in my view, this story is not over until we get to Omer's point, which is, will they do it again next time with less support? Because your point was, of course, the private sector needs to be in these places and learn, and part of the value of blended finance is to put the training wheels on so that they go and learn. I'm going to come to Audra next and ask you about Clifford Capital and the support it gets from the Singaporean government. How does that allow you to offer, competitive products across the debt capital spectrum? For example, maybe you can give us an illustration or two of where you're focusing, where strictly commercially constructed parties can't go, because you are a blended finance proposition. So where does that allow you to go that others can't? What countries, what challenges, maybe in the transition financing that is part of this conference?
So a little bit of history. So Clifford Capital was formed right after the global financial crisis in 2008. And I think back then, we were starting to see that commercial banks were starting to pull back from long-term cross-border financing. And that was actually the genesis of Clifford Capital. We were formed at the time hoping to address some of the financing gaps that were left by the commercial lenders, especially in lending to emerging markets, right? Because lending 15, 20-year money to these countries, it's not easy. And the tricky thing is actually we too think of ourselves very much as a commercial lender, which is why it's so important for us to utilize tools like political risk cover, which are provided by MDBs and to a certain extent even some of the private insurers in making some of these financing happen. So to say that we are providing financing where the market is not able to provide is also not quite right. But typically how we like to come in is we may come in at an early stage, work with our clients in difficult markets. So we've done projects in Bangladesh, for example, in Myanmar, where the framework is not necessarily very established or very tested. And then we work with MDB partners to see, which areas need to be enhanced, and then how we can structure the financing to in such a way that commercial lenders can then come in with money. So that's what we've done in some of these projects in emerging countries. But I do feel that PRI is just the tip of the iceberg, right? And on the subject of blended financing, I think there's scope for so much more innovation. And I think innovation is really at the heart of what we, as a part of Clifford Capital Holdings Group, do. We did that with financing greenfield projects in emerging markets. We have colleagues in Bayfront, which is our project finance loan securitization platform. And what they effectively do is extending what we do as a single institution to mobilize capital from institutional investors into long-term infrastructure projects. And again, that is another example of how people can innovate. There's a huge amount of expertise within the private sector to structure financing solutions. We're not utilizing that enough, I think, because a lot of this philanthropic capital and impact capital, as I understand it, has been deployed through multilateral institutions. There's definitely more scope for these types of capital to actually work hand in hand with private sector players, including someone like ourselves, in order to be deployed in a much more wider and effective way.
So you at Clifford Capital have not just gone and done tough deals, but also try to pull other parties in. And your point is maybe the catalytic money can be working more directly, more frequently with those commercial parties. Got it. Yeah. So let me turn to Kruskaya for a second. Another transaction that showed up on the screen already today was the IFC MCPP transaction. I always forget what that stands for, the Managed Co-Investing
Managed Co-Lending Portfolio Program.
The Managed Co-Lending Portfolio Program. That was a mega transaction that exposed institutional investors to an asset class that they weren't very familiar with, which is private debt in emerging markets. And it allowed to structure for some things that are difficult for institutional investors, such as frontier markets, small sizes, non-investment grade markets. So what did you learn from doing that deal? Maybe explain it briefly. And is there going to be a repeat? Is it a permanent offering that IFC can keep putting forward?
Thank you very much. And I think I'll go back to Paul's point. We just need to have a simple offering at the end of the day. So the nitty-gritty needs to be agreed, but at the end of the day, you need to provide a simple offer. So the MCPP, program, and it's a series of programs that have been, already established. As mentioned in one of the slides, it has already, been able to bring 10 billion in capital. The idea there is that it's a platform for institutional investors where they can invest alongside IFC, taking the portfolio, diversified portfolio risk of an IFC, of the IMC balance sheet. So it comes alongside, it's, it's diversified and it's simple. I mean, I think that's the key lesson. So yes, there is a new iteration, and I believe it was mentioned as well, is the MCPP One Planet, now with a focus on, sustainable investment. So I think that that's, the latest. We are learning and, moving forward to other products as well. So we have, a bond that is called the Best Bond Fund that is seeking also with a two-layer capital structure to bring, senior participants with, with a junior cushion to be able to invest in sustainable and sustainability-linked bonds. With that, one interesting feature that we have is that to allow it to go into the most difficult countries, We are bringing a concessional piece through the IDA private sector window. So we are bringing, again, the big mobilization platform together with one specific piece. And then let me mention, John, I think there what it is important is the transparency. You know, how much of this capital, of what part of it is concessional? Because if we keep saying, oh, we just go a little bit earlier, or oh, we just have a little bit more patience, but we do not quantify, you know, that there is concessionality, how can we get to the commercial sustainability? You know, the idea is to say, yes, in the first iteration, we are putting concessional capital, but as we move forward, we get to commercial sustainability, and then the private sector can do it alone.
So I just want to make sure that we understand that the original IFC MCPP program essentially created a vessel where every transaction IFC did, which I believe was an infrastructure, went into this vessel, and institutional investors were buying pieces as assets went into that SPV. And the One Planet Fund, what were the projects in there?
It focuses on the, you know, part of the portfolio that is sustainable investments.
So it's all sustainable investments, okay.
And then, you know, an intermediary one was focusing on financial institutions. So we have done several iterations on the MCPP.
And you've moved billions of dollars with that,
10 billion.
essentially.
Yeah.
So essentially that's a multilateral development bank using its entire suite of investments to attract institutional investors as opposed to trying to do one-off transactions. And maybe you want to explain the private sector window a little bit, because I'm not sure this audience will know about it. That's essentially one part of the World Bank Group providing concessional resources to the more commercially minded parts, right?
That's exactly it, and I believe it was mentioned as, you know, having mobilized 17, you know, billion already. The IDA private sector window is the largest source of concessional capital that we have today, you know, within IFC. We're managing around 7 billion in concessional capital. The IDA private sector window is the largest one. It was established in 2017 as part of the resources that our sister organization, the International Development Association, IDA, you know, raises for the poorest countries. The idea there was that, you know, you need the private sector there. So to support transactions that IFC and MIGA, you know, our, you know, guarantee, you know, sister organization as well provide, you know, it was set up. It's, you know, it comes in replenishment periods. So it's a 3-year replenishment period every time. We just receive an allocation of 2 billion starting this July 1st. So that's what has, you know, increased our ability within IFC to do quite a lot. With that, and perhaps just getting a little bit into the scale, we have been able to, you know, move from around 100 million to 125 million per year of blended finance. If I take, you know, the last 10 years, the first 5 years, we were doing on average 125. In the next 5 years, it's about 500 million. So, you know, even on our ability to deploy blended finance, we have been scaling up, and having that available has been one of the key sources.
I suspect Bank of America and BlackRock would love to have access to IDA funds of the same variety, but I'll let you two have that conversation offline. Hiro, you have a background also running an enormous institutional investor of your own, so you come to us with that background. So institutional investors need to obviously mind their fiduciary duties and make sure that whatever they invest in yields competitive returns. So do you see an opportunity for the participants in the Net Zero Asset Owner Alliance to make investments that do that create competitive returns, and also have transformative impact, like seriously climate responsive transactions? And if so, what do you think blended finance needs to do to make that happen, both you know, competitive returns and heavy-duty climate impact?
Thank you. Actually, you put in many questions in the one question, so let me try to address it.
I cheated. I snuck 5 questions in. Sorry.
Well, obviously. So the fiduciary duty very often got in my way when I was promoting sustainability at the GPIF. And then I think there's different way of defining fiduciary duty. And a narrow definition of fiduciary duty is you have a responsibility as a fiduciary to pick the better investment for your beneficiaries or constituency. And then that concept I do understand, but at the same time, I introduced the concept of universal ownership or universal responsibility, which is You know, if everybody trying to better off than anybody else, at the end of the day, who's responsible for systemic failure? And the climate risk is really a systemic risk for any portfolio you own. And then I also found it really kind of like a silly for the asset owner competing. Hey, my portfolio it has less vulnerable to climate risk. Yeah, everybody has the same vulnerability to climate risk, whatever the portfolio you compose. So I think the one thing that everybody has to be to recognize is we are facing systemic risk. We have the mutual responsibility to reduce that risk. So one of the things which I have been advocating at the GFANZ level is we should hold the other player accountable for you to achieve your net zero goal. For example, let me say, like Japanese pension fund cannot achieve their portfolio net zero unless BlackRock and other asset managers agree to produce, the manage their portfolio in that way. But we give them a benchmark for them to manage their portfolio. So that unless the index provider changes the benchmark, even as big as asset manager cannot really achieve net zero portfolio. So I think this is something like you just need to have a little bit, the new and a modern definition of the fiduciary duty. You really need to hold each other accountable. And the second point is, I just want to touch upon the why, when I was running a GPI, I received a lot of mails and the Twitter direct message asking me to consider $5 million investment in Africa. I mean, out of $1.7 trillion pension fund. And it happens very often. And all the time I was thinking about how we can scale up. And if you look at the history of the financial asset class development, there's only two ways for any asset class to become really, the major asset class. One is if you can come up with a template. So the institutional investor doesn't have to compare, can make an apples-to-apples comparison all the time. So green bond, those kind of things, at least tick that box. So have an opportunity to grow even further. Because everybody knows when people are talking about green bond, this is what we are expecting. And the other possible way to build the asset class is to come up with the outsourcing structure. It's like a private equity become the major asset class. If you can come up with the outsourcing mechanism for somebody you can depend on, and you can have a governance, but you need to let them be operating for you to aggregate assets. So that thing is missing in the blended finance at the moment because I have been helping the IFC and all the others and ADB trying to come up with a blended finance idea, and each of them looks, first of all, it's a little bit different from each other, and the second is we really cannot agree on a governance mechanism to hands off from what's going on. So the recent innovation of blended finance, which we have been trying to promote, the innovative finance facility for education or climate, and the ADB is really leading the way for education and now for climate. That's bringing the philanthropic grants to subsidize interest costs of the developing countries when they agree to use that fund for their sustainable project. Because the dilemma is, if you increase the borrowing capacity of the developing countries, they have to pay more interest. So that you need to solve that dilemma. But here comes the dilemma, another dilemma of the philanthropic fund want to hands-on on each project. So we just need to come up with that kind of like sort of like a fund manager or a private equity fund manager type of the outsourcing structure to scale up. And I'm really hoping everybody's work come up with that kind of structure, and then we can really the scale up very quickly. Yeah.
All right, so that makes sense. So first of all, redefine fiduciary duty. So they're all universal owners of planet Earth, essentially, with responsibilities toward it. Secondly, templates and standardization. And third, figuring out some large, simple things that can be done without each party putting its hands into the batter and stirring, right? Some simple ground rules that allow things to go forward quickly. All right, now we're going to turn to Fabio. Poor man, last but not least again. But the reason he's last is because, again, who would have thought that the IMF would be on a panel talking about institutional investing or blended finance? It is evidence of the increasingly obvious point that all of this stuff is interconnected. And so I'm very glad to have him here. So we're talking, Fabio, about climate in an era of really high public debt. A lot of the emerging markets that we're all trying to push forward really have not very much headroom on the government side, which I would imagine means that private sector investment gets even more critical for climate. So the IMF Executive Board recently approved the formation of something called the Resilience and Sustainability Trust. And I want to make sure that everybody here today hears about it and understands what it is and how it deals with climate change. So maybe you could elaborate a bit on that initiative for us.
So maybe I'll step back for a second and trying to think about what are the barriers to private capital, right? And what then the role the fund can play and the resilience sustainability facility. There are barriers both on the, if you want, demand for funding and supply of funding, right? In terms of demand for funding, there are issues related to project developments in emerging markets, project risk, sovereign and macro risk. So a number of issues that are related to do on the demand side. Then there's also a number of issues on the supply side. So in terms of return, for example, so what is bankable with sufficient return, the pooling of project, the lack of scale of structure that can actually aggregate, a lot of the structure are bespoke, and then slots, right? When you think, I don't know, venture capital, private equity, does this fit into this structure? So those are some of the barriers that we face, and so how can we fix those? And I think there's a number of steps to take. One has to do with, and some of this has been mentioned, thinking about financial instruments, so broaden the set of financial instruments from bonds to sustainability-linked bonds. Part has to do with broadening the investor base, and this is why it's so important to bring in as much different sorts of capital as possible on the private sector side. The role of the MDBs in terms of like project selection, in terms of financing instruments, in terms of risk absorption. Not only just the scale or quantity of risk absorption, but also in terms of the making sure that for each dollar that it's invested, that we lever up as much as private capital as possible. And then, again, improving what I call the climate policy, so create the right climate policy behind, and this climate information architecture, so more availability of data, better data, transparency, comparability of data, together with transition finance, taxonomies, that's particularly relevant for emerging markets, as well as global standards. Now, what is how the fund fits in all of this, right? So the fund that this trust that you mentioned, essentially that what we call RSF, the Resilience and Sustainability Facility. So this is essentially complementing the existing IMF toolkit. It helps low-income and vulnerable middle-income countries to address long-term challenges, whether this has to do with climate or preparedness for pandemic. And complement the IMF tools along two dimensions. One, by supporting policy reforms. So those policy reforms that may reduce macroeconomic risk from long-term structural challenges, again, related to climate, and also increasing policy space and financial buffer for some of these countries. In terms of the structure of the fund, the countries that are eligible for the RSF are low-income and vulnerable middle-income countries, so about 75% of the IMF 190 members. To have access in terms of requirements, to have access to the RSF, you need to have high-quality policy reform, you need to have a concurrent IMF-supported program, and then sustainable debt, so a trajectory in terms of capacity to repay. It comes with streamlined conditionality as a 20 years maturity and a 10.5-year grace periods. In terms of what we think this can do, I think one can improve the investment climate. So by setting in place or help setting in place a robust set of macroeconomic policy. But also the fund, I think, can lead one by improving this climate information architecture, so taking the lead in terms of data, in terms of pushing for transition taxonomies, as well as global adoption of disclosure standards, and also can be a catalytic role in terms of attracting private capital, as so part of the discussion that we had so far.
Okay, thank you. I want to ask maybe one party representing the development bank world, Kruskaya, that would be you, and maybe Omer representing the project finance space or the private finance space. What opportunity do you think there is for donors to leverage more capital to crowd in investors at scale? neither of you represent the donor side, so this is your chance to sort of make an ask of the donor component of the equation. So maybe from a development bank perspective and also from a totally private commercial bank perspective.
Thank you, John. And I think I'll go back to the point that I made before. We have been able to scale up some of the deployment. We still need the individual projects. Whether we use intermediaries or no, we need the individual projects. So IFC has been investing a lot on upstream, right? How do you create those projects at the beginning? Donor partners have been, exceptionally, supportive of that as well. But I think when it comes to, to the climate space, we still have a significant gap in availability of funds. So we have been able to scale up the blended finance within IFC because of the IDA private sector window. Again, that window allows us to invest in the lowest income countries where some of the climate mitigation opportunities are not available, right? So at this moment in time, we see a huge, gap when it comes to the ability to do climate projects supported by blended finance. With the newest technologies, you not only need this funding to de-risk, but you also need this funding to help reduce costs until those technologies get to a more sustainable area. So I will say consider additional funding, consider capital that is flexible. Some donors are going into the returnable capital space. That has been a little bit of a challenge because you cannot provide significant concessionality when a donor partner tells you you have to protect my principal. I mean, you are limited on how much support you can provide. So probably those will be the points that I will make.
Okay, so a lot of donors are focused on LDCs and fragile environments, and climate finance is not necessarily in those geographies. And then secondly, the more that the catalytic money asks for a return, the less catalytic it becomes, if I could summarize, right? Omer, thoughts from your side?
Yeah, and I'll confess I'm not an expert in donor finance. When we look at the space, I think what we find is that capital is there. You could talk to all the large money managers, they have a sustainability strategy. All the banks have a sustainability strategy. The MDBs have capital, the governments have capital. What we don't have oftentimes, and I think we don't focus a lot on it, is that ultimately this transition is going to require a lot of talent and a lot of entrepreneurship and a lot of creative thinking. And I think where donors can really come in and help is that very early stage business incubation, feasibility studies, technical grants, educational grants, because, as my opinion, I think at the end of the day, capital and scale alone won't get us there. It's going to require the generation behind us that's going to be really creative and change how we do things and come up with the next best idea.
So I'm hearing a little bit of donors should be operating in the very, very early stages, in the crucible stage, in the invention stage of transactions. Paul, I might ask you if you have additional thoughts as well, but before I put you on the spot, I just wanted to remind everybody that you can ask us questions. You can send questions, and my Slido has quit working, but you can send questions to slido.com, hashtag TFNZ, and I think there is a QR code up there that you can use, so please send us good questions, and I'd be happy to present them to our panelists here. Did you want to add anything more, Paul, from your perspective at BlackRock about a call out to the donor community as to what maybe more could be done to mobilize money at scale from their side?
So on that specifically, I mean, there is a tendency in the world of climate diplomacy, which does drive donor activity, and I say this as a former US government lead for climate finance, there's a tendency to divide into regional blocks and developed and developing. We just need to remember, and budgeting is done differently for domestic purposes versus international purposes, right? We just need to remember that unless the green transition happens everywhere, climate risk will be unmanageable anywhere. And so when we think about the money that's being spent within a particular donor country versus the focus, the degree of focus on actually mobilizing decarbonization in emerging markets, we have to think of it as one world from the point of view of the money invested in enabling decarbonization, right? Because it's not going to be enough for the United States to effectively drive towards a net zero economy within the borders of the United States that will not protect the citizens of the United States from climate risk if meanwhile emissions are spiraling upwards in other markets. So there's like a mindset shift on that. But I'm happy to defer. I have a view on the sort of the role of blended finance in scaling up, but maybe you want to come back to that or go ahead? Go for it? Okay. So, I mean, I think as I listen to this panel, clearly there's never been more goodwill for private and public sectors to work together, and pressure. But the fact is that public and private capital are not very good at working together, and they often don't like to work together. But we need them to, right? So what is blended finance? To me, blended finance is a kind of laboratory where you draw a boundary around a limited number of actors who have decided that they do want to work together, and they negotiate the exact arrangements for working together in order to invest in something specific. That is what blended finance vehicles are. They're kind of closed loop laboratories, and it takes, as I said earlier, it can take a very long time to negotiate those terms. The problem is we don't have a lot of time. And so as emphasized in your excellent State of Blended Finance report, we need to focus on scale and ask not just, our blended finance facility, the Climate Finance Partnership, is $673 million. And that sounds like a lot, but it is just an artisanal fund on the scale of climate investment that's needed. And we don't have time to replicate artisanal funds one by one through these closed-door negotiations over time. So we have to ask ourselves, what would it look like to take all of the lessons from the negotiation of many blended finance vehicles and try to implement that, let's say, 2 orders of magnitude larger scale? What would it take for the MDB system, which has organized itself around climate, the DFI system, which has also organized itself via the IDFC, and the private sector, which is also organizing itself to collaborate at a much higher level of resolution higher level than the creation of these individual vehicles. And I think that's the great challenge for those of us who work as practitioners in this space to figure out.
Yeah, I so hear you that we need to stop having individual cobblers tinkling in their shops, and we need to get to major industrial scale, rolling off the assembly line kind of blended finance. We have a lot of questions coming in. I'm just going to bring up some of them now since we have about 8 minutes left. And maybe this one, and I don't know, Fabio, if you want to take this one on, but one question is coming in. Do you see regulatory and government policy being a major hurdle in the ASEAN or the Asia-Pacific region in terms of trying to really create an appetite for investment in the region? Is there really how would you say, a barrier being put up by regulations that is slowing things down? And if so, is there anything to be done about it? I don't know that falls necessarily in the realm of something blended finance can address, but do you want to maybe talk a little bit about that?
I think in general terms, right? So I think one important point, and that's what I was trying to make about the Resilience and Sustainability Fund, was to create a climate environment, right? So you need to attract private capital and have the climate environment that it's conducive to that. So part of it has to do with climate policy. I think the fund has been very vocal in having the carbon pricing in place, for example, to get price signal. Different countries have followed different approaches. If you look at the US, it's more subsidy-based, but also you need some of the regulatory policies in place. And there's different way of thinking about how to design regulatory policies that are more climate friendly. I don't want to go into specific of individual countries, but there's different approach to regulatory in terms of incentivizing capital, in terms of thinking about financial stability risk, for example, and what central banks are doing when they think about that. So I think it's a package here. And then again, this is climate information architecture. You need data, you need taxonomies, you need disclosure. I think you want to take the package as a whole. None of this individually is going to be large enough and fast enough, I think, to get to scaling up private finance expeditiously as we need.
Yeah, I think there's maybe what you're saying in part is there's a limit to what blended finance can do. There's a whole bunch more of other things that need to happen correctly, including so I think the question gets to that point. The blended finance is not the be-all and end-all solution. We have a lot of people who have voted in favor of a question that's somewhat awkward, but I will toss it out there and see if anybody would like to take it. The question is about whether perceptions that someone is investing in something in greenwashing or green labeling the transaction may be slowing down private sector investment in the space. Are any of you seeing that perhaps people are concerned that if they put their money in something, they'll be told that they are greenwashing when really they're trying to do something constructive? I don't know, Audra, do you want to take a crack at that one?
Yeah, so maybe I can talk about it in the context of transition financing, right? And I think it's in recent years, a lot of banks have made pledges against not financing any more coal-fired power plants, for example. And obviously that's done because it creates a lot of negative perceptions that you are increasing carbon intensity, et cetera. But the reality is that coal-fired power plants still account for a lot of energy generation in this part of the world and in others as well. And in order for us to transition away from these coal-fired power plants, we need to develop a whole lot more renewable power capacity. There's no shortage of capital available for renewable power. In fact, they are probably competed to death with razor-thin margins, probably higher than desired levels of risk. But what can we do to address coal? There are a lot of talk in the industry about how do we incentivize the early retirement of coal, for example, but how do we get the right types of capital to make this happen? We think that blended financing actually it can be a very good tool to utilize towards this end, but that does entail people willing to put fresh capital to displace perhaps existing capital in order to bring about early retirement without people necessarily taking a loss on an investment that they made a few years ago. And as I think was noted in discussions at the earlier part of today, some of these investments are actually not that old. They still haven't even seen significant returns. And they are provided by people like pension funds that have a fiduciary responsibility towards their investors. So I think this greenwashing concept has to be managed very carefully. I think everyone in this room, we face an immense amount of pressure from activists and things like that. But I think perhaps there can be more concerted effort, maybe around work on taxonomy to have people not perceive putting some money to work in brown to green type projects to be seen as evil and bad for the earth and things like that. I think that can go a long way in doing the just and responsible transition.
Yeah, a lot of what we're talking today is basically coloring outside the lines, right? So we're talking about donors not insisting on being in LDCs if they also want us to deal with climate. We're talking about blended finance and structures that recognize that the U.S. is connected to the rest of the planet. To Paul's point, you can't just have a U.S. deal or whatever. And now we're talking about coal being part of the solution in terms of having to invest somehow in a transition, and you're going to have to deal with the fact that coal is still in the picture. So I think all of those are really, really interesting points. Let me come up with a couple other interesting questions that have come up. A lot of people wanted to know, Paul, if you could share more about the lessons that you mentioned about how long it took to pull together the catalytic slice of the climate finance partnership. What was going on there? What can we all learn and not do again, maybe?
Sure. Well, I think part of this has to do with the earlier conversation about the evolution of DFIs and MDBs, and there was a very high-level political commitment that launched, in our case, the creation of the Climate Finance Partnership. It involved President Macron. It involved there was a high-level commitment, but then when it came time to implement that, right, we had incredible partners in AFD, KFW, JBIC, but the systems weren't necessarily geared at allocating capital from those institutions for structures like this, right? So this gets to the point about needing to reimagine the role of the MDBs and reorient the way that DFIs typically work and the KPIs that people are focused on in terms of is mobilizing private finance an actual KPI that matters or not. So I think fighting through some of that took a while. And then again, just agreeing on a capital structure and a waterfall of returns that would work for them. Remember, this was 3 DFIs and 3 US foundations, which themselves hadn't worked together before. So there are 3 kind of actors here, right? We had DFIs, philanthropy, and institutional investors who were the last in the story to come in because we needed to structure something that we thought would attract them. And again, it just took time, and it was a bespoke thing, right? That's why I refer to it as artisanal. We did not have a template. We had to make it up from scratch, and that's what I fear. We cannot afford to make everything up from scratch all the time. And as you said, Joan, the proof will be in whether we could, for example, as the general partner, raise another fund with the same structure to do it all over again. But there's not enough standardization, and so that's really just what took a long time.
We have a question about risk appetite. Chris Garcia, you mentioned the donors and their risk appetite, and there's a question here about, there's a perception that development banks have the same risk and return profile as BlackRock, Bank of America, and so forth. So should donors be working with DFIs if they're not themselves being more catalytic than a BlackRock or a Bank of America? So maybe you want to comment on risk appetite in DFIs as compared with institutional investors.
Yeah, I think, there was already mentioned in the earlier panels that at the end of the day, it's our stakeholders. We have a AAA that today we are protecting because we need to ensure that we go and then bring this additional capital, in the capital markets to allow us to continue being the mobilizing machine that we are. So from that perspective, when it comes to IFC's own account investment, it has, an investment, mindset, a commercial investment mindset. With that, however, we do have a development mandate. And therefore, there is a portfolio approach that we are taking on our own account investments. What we do with blended finance is complement that, but instead of having in the room 3 actors, you have in the room 2 actors because you have IFC or, the DFIs, and the DFIs already with the catalytical or concessional capital that has been provided at scale. Why? Because we are providing very specific, agreements to the partners of how we are going to manage these funds with specific, principles, with, clarity and transparency of how we use it. So at least you are able to do that. But I think, from the own account perspective, John, that's the, today that's the world in which we have. We have a AAA, and that AAA needs to be managed. On the other hand, our, stakeholders are saying, yes, we're going to complement your resources with the blended concessional finance for you to be able to stretch your balance sheet further.
I'll add a couple other things on risk appetite, because we do see transactions all the time where we have commercial banks and the MDBs side by side, so that does work. I think where the MDBs, from our perspective on risk appetite, can really help is the MDBs have a lot of data. They've been in these countries for a very long time. They have experience. They know the laws better. They know the policy that is in the works better. So, if there's a way for the private sector to leverage that knowledge, I think that could be very beneficial. The other thing I wanted to say, and I think it's a different topic, is that, we've talked a lot about scale. When we talk about business models that don't exist today, how do we do electric vehicle charging in Africa, or how do we do rooftop solar on a scale basis? We have to keep in mind that that first transaction isn't going to be scale. It's going to be small. It's going to take a long time to do, but if we do it right, it should lead to scale. We've seen that in solar and wind in the developed nations. 10 years ago, your largest asset was 50 megawatts. Now it's 5 gigawatts or 500 megawatts, right? So I just want to make sure we don't let scale in the way of doing work. The scale will come, but it requires the parties, frankly, on this stage to work together to come up with the right mechanism so it's scalable, but not necessarily scaled today.
Right, there's a little bit of an off-ramp then between high risk, small, and pass it on to the next generation of investor until you work your way up to, institutionals. Hiro, you wanted to add, right?
I just want to first of all touch upon a greenwashing concern. I always say greenwashing better than not being washed. So still better than doing nothing. But I think the greenwashing concerns are usually used as an excuse by the people who don't want to push this agenda. So you have to be careful. But the second point is, actually greenwashing becomes really relevant and important when we promote the transition finance. Because the transition finance can be used as a tool to sort of like support the slowing down the progress of transition. So transition finance has to be made to accelerate the transition. That's the one major criteria of any transition finance to be transitional finance. I saw the other question about the family office role. Can I respond to that?
I told them ahead of time they're allowed to hijack the panel, and so
yes,
go for it, Hiro.
Yeah, somebody asked us about the role of the family office, and I always think like the people fund like a pension fund. I was a fiduciary to the 110 million Japanese pensioners, and a lot of time I was asked whether my action is really representing their belief, and I always responded, how can I do that? But if you're running the family office, you really can have the strong value angle, what your fund want to achieve. And I think that applies to the other institution, which you don't have to be a fiduciary of the unnamed, the big number of the beneficiary. So I think the family office really can play a role by promoting your founders or your family's value. By reflecting that in your portfolio composition.
Yeah, they have huge flexibility, right? They can do everything from very hard commercial investing to total philanthropy and everything in between. So I think that flexibility is what you're talking about, because you're just answering to a principle, a family office philosophy. We had a question for Fabio, and I think this is a useful one since we're in a climate meeting. You talked about upstream investments, but what about shipping? Do you see any ideas or solutions for crowding in capital for the maritime sector? It came up earlier today, too. It's a huge sector, and we don't really talk about it that much, so I'd love to get your views on that.
So I don't particularly cover that sector, so I'm not sure I'm the best person to answer that question specifically here.
I can take a crack. And maybe I'll have a question for Omar. So shipping is very interesting because the shipping sector is actually the most advanced, I would argue, among global sectors that have organized themselves for decarbonization. It's aided by the fact that shipping has a global regulator of sorts, the International Maritime Organization, which adopted a global decarbonization goal a few years ago. It's not a net zero goal, but it's a very clear goal. And there's a lot of technical analysis that shipping industry was part of that involved setting that goal. And then what happened was that a number of banks agreed on a set of principles for asset finance, this comes to you, that would be in line with the trajectory needed to reduce emissions in the shipping sector. It's called the Poseidon Principles. And then the cargo owners, the customers of the shipping sector, adopted the same standard. And then the insurers who insure the cargo adopted the same standard. So now there is a standard for asset finance of ships that is adopted by the cargo owners, the customers, right, the banks, the insurers, and it's anchored against a globally agreed goal by governments. And now the fact that that has all been done gives governments more confidence to go back and try to agree on a more stringent goal. So you see this flywheel effect starting to happen in the shipping sector. This doesn't have a lot to do with blended finance, but it is, to me, just one of the most interesting sectors to watch. So I can't remember if Bank of America is part of that group, but it was an asset finance centric thing at first.
Yeah, and I don't know the answer to that either. But look, I think the lesson there is that when you have transparency in regulation and a stakeholder understanding and support of regulations, it really helps you move. And I think the EU taxonomy has done a good job in that regards too, that it's aligned standards, and we, it's the first iterations, it's always a work in progress, but it's good to have people focused on the same items and in the same methodology of thinking. That just leads to more capital, leads to more development.
So maybe I can add to that as well. So what I haven't mentioned earlier this morning is that in addition to our focus in infrastructure, the other half of what we do is actually in the maritime sector. And shipping is actually a very interesting subject because it's probably the second most carbon intensive activity that we would have to deal with. Singapore is an international maritime hub. And right now, the sector in itself, there's no commercially ready, scalable, alternative carbon-free fuel. And actually, there is some ways before we get there. And we are not a signatory to Poseidon Principles, but we carry out our work in a similar way. We track what IMO is doing, and we also try and deploy capital to ship owners that are forward-thinking and thinking about how they are making this trajectory themselves. We prioritize financing for dual-fuel vessels and for vessels that are ready to make the transition, whether it is to ammonia or to methanol or some other fuel that might be more readily available in the future. And I think importantly, the other thing that we've also been doing is to speak to the Maritime Port Authority of Singapore. We are looking into ways of maybe even thinking about electrifying the nearshore, hovercraft vessels. So I think it is, it does take a concerted effort from all segments of the industry, including capital providers like ourselves. And I think it's also a very good example of the partnership that's required to achieve decarbonization. So other than infrastructure sector, very much in the maritime sector as well.
I knew there'd be somebody up here who knew the maritime sector since we're in Singapore. And actually that does make it a blended finance thing again, because your firm, of course, starts off as a blended finance initiative. So the fact that you have the patience to sit there and work through these issues kind of proves a point in a way. We are almost at time. I want to ask a very quick lightning round of each of you. If we want to get to scale in climate, what is the one thing that needs to happen that isn't happening enough, or that needs to happen at all? So is it, a different kind of blended finance interaction? Is there just something that's not happening there? That I think one of you already mentioned something, which was data. Who was that? Was it?
Yeah.
It was you,
So,
Omer. Okay. So lightning round. What's the one thing that needs to happen to get to scale using blended finance so that institutional investors can come in?
Yeah, I think it's data and transparency of data. How have deals performed? How has some technologies performed? How have investors fared? I think the more information that's out there, the easier it is for institutional investors and commercial banks to come in.
Data. Okay. Any other responses very quickly?
I will say availability of flexible, concessional, and catalytic capital. I mean,
Okay.
the 1 to 11 is possible. We have done it for the last 10 years in the climate space with blended concessional finance. But if we don't have the 1, we cannot get to the 11.
So there's a constraint on that sort of capital. Anything else, Hiro?
Yeah, I think we need an aggregator of all the different opportunities to really scale up, very quickly.
Okay, an aggregator. Paul?
National Green Investment Banks, commercially operated, publicly owned.
All right. And Audra?
I would say partnership. I think MDBs have done a great job in mobilizing philanthropic and impact capital. I think the private sector has a role to do this and to push this further ahead than where we are today.
Fabio, any thoughts?
I think I go back to the data. I think you need better quality data, more available, more comparable across jurisdiction in combo with the transition finance, taxonomies, and global standards if you want to have global markets.
Thank you all very much. We're going to end it there in the interest of time, but please join me in thanking our panelists with a round of applause.